right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack, founder and CEO of Better Books, where it is our goal and aim to help you, the real estate investor, the entrepreneur, the business owner, eliminate all that frustration that you feel around taxes. You know, most people in this country, that is a blessed country. We are blessed to be in the position that we find ourselves in, even though it might not feel like that of late. But we know that most people in this country are very frustrated. They're fed up with a lot of the things that deal with taxes, not the least of which is the amount of money that they seem to hand over to the US government in the form of taxes. And so we have created this podcast and our business to help you eliminate that frustration by bringing down those amounts that you hand up over to the government every year. So if that's you, you've come to the right place. I'm excited to be here with you. And today we're going to be talking about a topic that is very important to all of us. And it is the topic regarding the increase in tax rates that you will likely see if nothing else changes. Why is that? Well, come December 31st, 2025, the changes that were implemented dating back to January 1st, 2017, when President at the time, Donald Trump, passed his Tax Cuts and Jobs Act, all of those benefits that we've seen, or I shouldn't say all of them, a lot of them are expiring, including the rate drops that we've seen at the individual level, which means we will see a rate increase at the individual level across most tax brackets. So for one, the 24% tax bracket will be bumping all the way up to 28%. That is a 4% increase in taxes. So today's conversation will be around what you should be expecting and what you can do and why we're going through this process, right? Because it's one thing to tell you that it's coming. It's a whole nother thing to help you understand what you can actually do to take responsibility and eliminate that risk of greater tax payments. Because like I said, we know that the majority of Americans are not happy with the amount of money that they hand over to the US government in the form of taxes, especially when you think about where the heck is that money going? Because my life does not seem to be improving as an American citizen every time that I pay that tax bill, right? We see these massive amounts of money going out to fund things that we don't really have a say in, and to think that that amount of money is only going to increase cause for concern. So today we're going to be really diving into what you as the taxpayer can do, why you should be prepared for this, because again, it's sure thing, barring any changes over the next couple months or years. So December 31st, 2025 is really the year that you should have marked on your calendar as the year that taxes go up once again. So again, this really deals with the 2017 Tax Cuts and Jobs Act. When Donald Trump came into office as president, that was one of the big things that he did. He cut a lot of taxes. Corporate tax rate went from 39% and they dropped all the way down to 21%. That is a permanent change. That does not expire. So if you have a C corporation tax at the corporate level, you have not as much to worry about. But if you have a salary from that C corporation, which many of you do if you're operating that, then it's something to worry about. So tax rates at the individual level will increase. Like I said at the start, 24% will go up to 28%. $100,000, you now pay not $24,000, but $28,000. And those are estimates. We have a progressive tax system, which basically means that not all of your money is taxed at that level. It'll be less, but it can be upwards of $4,000 worth of taxes that you will be paying as a result of these changes. You don't change anything else. It's just a matter of going from 2025 to 2026, and your taxes will increase automatically as current law stands. So what can we do to help? What can we do to eliminate the risk of overpayments that we will face as American citizens? Well, first, start tax planning, right? We know that one of the best ways to save on tax is to plan for tax. And I'm not saying planning to pay taxes, right? I'm saying planning to save taxes, planning to avoid taxes legally and ethically. We can do that through the form of tax planning. I'm telling you, if we know that in 2026, you're going to be taxed at 28%, but this year you're taxed at 24%, well, don't you think we would want to pay taxes at 24% now and not at 28% later? Those are things that we can plan for. Things like Roth conversions, right? If you have a large amount of money in a IRA, traditional IRA, say $400,000, and you know you want to convert that to a Roth so that you can have a tax advantaged account when you go to retire in 10, 20, 25 years, whatever it is, a Roth conversion is an opportunity that you can seize with tax planning. And when you know that tax rates are increasing in 3 years, 2 years, really, a year and a half. I mean, if we're being real, next year is 2025. And so if you know that, and you also know that a Roth conversion forces you to pay taxes in the year that you convert, well, wouldn't it make more sense to convert it when tax rates are lower than waiting when tax rates are higher? You save $4,000 on every $100,000 that you convert. That's a no-brainer for me. And so these are the things that you want to think about, okay? What about real estate? Is this the year to invest in real estate? Or do we wait until future years because we know that the tax savings are going to be worth more in future years because of that increase in the tax rate, right? Typically, I say that tax saving in the current year is worth more than tax savings in future years because you not only get the savings and then you also get the compounding interest, compounding ROI on those dollars saved, right? If I save $5,000 this year and I'm able to get a 10% return on investment on that $5,000, well, next year I have $5,500 compared to saving $5,000 next year. That makes sense? There is a benefit to getting a tax savings in the current year, traditionally. However, if we know that tax rates are going up in the future, we might hold off on some tax savings so that we can have a greater amount of savings in a few years rather than taking it all in the current year. These are things that you want to think about, things that you want to consider, things that you want to talk about with your real estate tax specialist, right? If we know that the tax rates hikes are coming and we know that there are certain industries that offer greater tax benefits, well, maybe it's time to start making connections with people in those industries so that the time 26 rolls around, you're ready to take action, right? We recently launched an episode about oil and gas investing. Well, if oil and gas investing remains to be a tax advantaged asset in 2026, well, maybe that's the year that you seize it, or maybe you double down on it in that year. So these are things that you want to be thinking about, right? We can't just go in blind. We have to know that prices are going to increase. We have seen prices increase dramatically over the past 4-5 years. Inflation has increased at a rapid rate. And now you're going to add an increase in the tax rate to that. A lot of Americans are going to be in trouble and going to be very pinching their pennies. So be on the lookout. Don't say I didn't warn you. These are things that we as entrepreneurs, as investors, as tax specialists, we need to be aware of. And if your CPA or your tax preparer or your EA is not coming to you and saying, hey, we're looking at a tax rate increase in future years, we want to get things figured out this year, this is the year to start tax planning. Well, then if they're not saying that, it's time to find a new planner, a new professional, right? We had a client, he's a military guy, he's investing in real estate. He knows that tax rates are going to increase in the future. He has a lot of money in an IRA. And so we advised, hey, this is probably a good year, this year or next year, to consider at least a partial Roth conversion, taking some money that you had in your traditional IRA, converting it to a Roth. And then, guys, the thing about the Roth is that you now have that bucket of money that will grow when you invest it, and all of that will come tax-free in retirement. So with our clients, he is working on a conversion in these low tax rate years so that we can get it converted. And then in future years, when tax rates are higher, we can take that money out tax-free because of the conversion, right? So it's part of this planning game. I think about your approach to your business, right? Say you sell a seasonal item, right? Say your items are in hot demand during times like Christmas, right? Maybe you have something that's specific for the winter months. Consider like fireplace materials or even fireplaces themselves. Say that's your item. Well, you're going to plan around the fact that sales are likely going to go up in those winter months, right? November, December, January, February, March. You're likely going to see an increase in sales when demand is high. And so what are you going to do when demand comes down? You're going to plan for that time and say, hey, what can we do? Can we pivot? Can we sell something else? Can we sell something that's more summer demand related? Can we sell or give discounts in times where there is less demand for fireplaces? Or maybe we sell outdoor fireplaces, right? In a business, you plan for those flows that you receive in business. The same thing goes with taxes. We know that in 2 years, taxes are going to increase. So what can we do now to plan for that increase in taxes, right? We can pay taxes now and not later. Maybe set ourselves up in an entity that will save taxes in future years, because maybe even your tax or your income is going to go up. Maybe it's not doing it right now, but you can create an entity that sets it up now for success so that when the income comes up, you are not paying a massive amount of taxes. These are things you need to do, but you need a professional to work with, to know, to build a relationship with, to trust, so that you can have these conversations and consider the things that you're doing and why you're doing them, right? Be like our client who was able to convert in these low tax rate years and pay a lower amount of taxes this year than he would in future years, right? And if you can avoid taxes altogether through the power of real estate, through the power of business ownership, through the power of entity structures, whatever it is, do that. Maybe you need to plan for deductions. Maybe this year isn't the best year to take deductions, but future years are good, right? These are all things that you need to be considering because tax rates are going up. And it's not on you to be keeping track of it, but you should be aware of it, right? Your CPA, your EA, your tax professional should be proactively looking at changes in the tax environment, right? We know that an election is coming up. We know that there are tax proposals on the table. Your CPA should be thinking about what proposals are better for my clients, for my business owners. I'm going to vote for that client that is more friendly to that candidate that is more friendly to our business owners, right? This is the job of your CPA, to be pushing you in the direction that is most prosperous for your business. That includes looking into the future and saying, hey, we are looking at increased taxes. Let's look to pay taxes now so that we don't pay taxes in the future. This is what you do in tax planning. It's not projecting, it's not preparing, although that's usually included in tax planning services. It's looking at your situation and the situation that's to come and saying, what can we do to keep the most amount of money in our accounts right now and in the future? This is tax planning. And with the increase in tax rates coming, it's all the more important to start taking action now. Okay, so maybe you're not converting a Roth, maybe you're not taking deductions, maybe you're not buying more properties, but maybe you just need a plan. That is an option, and this is the time to do it because there's something that you're missing. I can guarantee that. Most people we meet with are doing something wrong, or they've made mistakes, or they have had missed opportunities. And now is the time to figure it out rather than 5 years from now when you could have found out now and saved more on taxes and eliminated some of the hurt that you're going to go through as tax rates go up, your bank account suffers, and you continue to have to pinch pennies. So this is what we're here for. This is what we want you to do. We want you to be equipped to make confident decisions. If you're considering something like a conversion, reach out to us. If you're thinking about taxes and the way that it's going to be impacting your bottom line and what you do as a business owner, reach out to us. We know that it's stressful. We know that it's confusing, but it doesn't have to be. With the right team in place, you can save on tax, you can have confidence, you can have certainty, you can eliminate the fears and the frustrations that you've been dealing with for 10 years now, and just invest in making a better business, keeping more money in your account, and watching your family and your life grow. I trust this was helpful. I trust you found value. If there are things that you would like to hear about, be sure to reach out. You can find me on Facebook, Instagram, LinkedIn. Reach out to us at the Know Your Numbers show, or just follow me on Instagram, Chris McCormack, CPA. I check my DMs and you can reach out to me there. This is the Know Your Numbers REI podcast. I'm your host, Chris McCormack. And until next time, God bless you and keep moving forward.